Hey everyone, Corey here. What would you say if I told you that you could get into your favorite stock for 50 or even 75% less than the current trading value? Sounds too good to be true, right? But it's not. Let me show you exactly how you can do that with this strategy. But first, be sure to subscribe and tap the bell so you know when I post new videos. And if you really could help me out, give me a thumbs up. This way, it helps the channel grow. Let's jump right into the video at hand, and that is the stocks that you want to buy. You may not have a large portfolio. You may not have 20 grand. You may not have 10 grand. Heck, you may only have $500 or even $300 in your portfolio. What if you want to buy your favorite stock, but you just can't afford it? Let me show you guys exactly what I'm talking about. I want to show you a strategy where you can get into your favorite stocks for 50 to 75% less than the value that they're currently trading at. So this way you can start selling covered calls and making money and growing your portfolio. It has lower risk than most strategies, and it's great for growing a small portfolio. And it's a very easy strategy to manage. And I want to show you guys step by step how you can implement this strategy into your portfolio and enter your favorite stocks at a hefty discount. First, I just want to mention that I'm no financial advisor, and this isn't financial advice. I am just trying to help you guys on risk management, different strategies, show you the technical and fundamental analysis on stocks, and show you how to read charts and implement strategies into your portfolio. It's up to you to decide how much money you want to put into a company, which company you invest in, and which strategies you decide to learn and use. These are completely up to you. Okay, guys, for our first example, let's say you wanted to get into NIO. You just want to invest in NIO, but you don't have $450 or $460 sitting around to get into NIO. You just go to trade options, and I'm going to show you guys how we're going to set up a leap call option, which controls 100 shares of the stock. And this is going to allow you to control the 100 shares of NIO while building a future base to own the stock much cheaper. First, we're going to go to buy and call. And then right here on the expiration date, you want to go out at least 8 to 10 months or even 1 year. You don't want to go too short term, like 4 to 6 months. It's not long enough. You want to go out at least 8 to 10 months or even a year for that matter. I would say a year is the sweet spot, 10 months to a year. And the reason is because you're going to be selling calls, which I'll explain in a minute, and you need time to build up the income and the premium. This way you can get into the stock cheaper. And let me show you exactly how we're going to do that. Right now, it's April 2024. So if you're looking at this video in the future, it doesn't matter the expiration date as long as you're going out 10 months to a year. Buy call January 17th, 2025. And then what we're looking for is to buy a call that's in the money. That means the call strike price is below the stock price. This way it can be exercised at any time because as a buyer, we have the right. Sellers are obligated. Buyers have the right. We're buying this contract, which gives us the right to exercise the shares from the contract. We want to make sure that our strike price is deep enough in the money that if the stock price comes down, the strike price of the option stays in the money. Remember, in the money means the stock price is above the option's strike price. And remember, out of the money is when the stock price is below our call option. That means that our call option is out of the money. For example, if NIO was trading at $5 and our call option was $3, the option is in the money. That's good as a buyer. As a seller, that's bad. If NIO is at $4 and our call option was $5, it is out of the money. Bad for a buyer, good for a seller. So in order to protect ourselves, the best and safest way is with a delta of at least 80. So a $2.50 call is 88 delta. That's very safe. That means it's 88% chance likely to be in the money at expiration. And that's exactly what we're looking for. However, if we know the bottom of a stock is where it's currently at and it's not going to go much lower, I can run 70 to 75 deltas as they're a little bit safer if the stock was to drop, as you won't lose as much money, but you've got to pick a strike price that's going to stay in the money. I'm going to explain to you guys in a minute what happens if the stock price drops below the strike price of your option. It's not a good thing, but I'll explain how you get out of it and how you fix it. So we can see NIO and a $4 call is a 72 delta. You could really start off by buying this call because NIO is not really likely to go below $4. It could happen. However, you could start with a 70 or 72 delta. And what you're going to do is you're going to click buy. You want to make sure to look at the volume and the open interest. 5,656 people are interested, and there's been 14 trades in a day. Very good option. So we're going to click continue, and we're going to try to fill it in the middle for about 163. That means we are buying this option contract, which controls 100 shares for only $163. You now control 100 shares of NIO, which would be worth $462. We're going to do it for $163 or even $162. Saving $300. That is 70% off. We're going to click review order, and then we're going to go ahead and we're going to buy this contract. Once you've purchased the contract, you can now sell calls against it just like you would if you own the shares. Your brokerage is automatically going to know that you have a long call that's in the money and allow you to sell calls. And the reason for it is when you own stock and you sell a call, let's say on NIO, we sold a $5 call, NIO goes above $5, it gets exercised, you get assigned, your shares are called away from you by the buyer. When that happens, you lose your shares and you sell the stock at the strike price of the call that you chose and you sold. In this example, it was $5. So you sell NIO for $5 times 100 shares is $500. If you have a $4 call option on NIO and you sold a $5 call option that NIO rises in price and goes above your $5 call, which would be right here that we could sell. If NIO goes above that and you get assigned, you get paid by the buyer $500, the $5 just like you would if you had the shares. You then exercise your long call position at $4 and then it automatically gives the shares to the buyer. You get to keep the $100 difference. You sold the shares at $500. You exercise the contract at $400. That leaves you with $100 profit. Plus you get to keep the juicy premium that you collected from the $5 call option that you sold. So it pretty much works the same way as stock. However, if the call option on NIO right now is costing $163, but we're only making $100 plus the cost to sell an option, then we're not really making money. The idea is to keep rolling out and up if the price goes up. This way we can keep selling calls. This strategy I use in two different ways. The first strategy that I use is to wait for the long position, the $4 call option we bought that expires 10 months to a year out. I wait for that position to be up 50 to 100% profit. Then I will close my call position by buying it back and sell the long position for a double gain. Plus, however many weeks I have sold a call option. So once we have bought that contract, we can now sell calls on NIO. So let's say for next week, expiring 8 days from now, I sell a $5 call. I'm going to collect $7 juicy premium. If I do this 4 weeks a month, that's $28 times 10 months, that's $280. So in 10 months' time, I've collected $280. This is my second strategy. It cost us $162 to buy the contract. Now we own the $4 call contract. When January 2025 approaches and the long call that we bought for $4 is getting close to expiration, the short calls that we've sold every week leading up to January 2025, we have netted a profit of almost $300. So now when we go to exercise our long call option, it costs $400 because the strike price was $4 times 100 shares. We can now use the $300 that we collected over 10 months to exercise the $4 contract, which means it only cost us $100. But then it cost us the $162 to open the contract. So we spent $162 to open the long call position. We sold $300 worth of calls in the 10 months. We exercised the position for $400. So $162 plus $400 is $562. minus the $300 juicy premium we collected in 10 months, meaning we got into NIO for $262. Essentially, we got in for $2.62, which is $2 less than the stock price is right now. And even if the stock price was to go up to $10, it's the exact same. Even if the stock price continues to go up, we can roll our short call out an extra week or two, or even 3 weeks, and up to the next strike price to collect more premium and to keep us from losing our long call position. So no matter what, at the end of the year, we would collect at least $300 or close to it in premium, even if the stock is at $10. However, if the stock was to go to $10 and we continue to roll out and up, 1 week it's $7, 2 weeks it's $7.50, another month it's $8, we just keep rolling out and up for extra juicy premium, and in 10 months we've collected $300. We still get to exercise the long call position for $400 minus the $300 that we collected in premium, plus the original $162 we purchased the long call position for. Meaning, even if the stock is at $10, which would be $1,000 for 100 shares, we essentially get it for $262. This is one of the best strategies to building a small portfolio and getting into your favorite stock real cheap. You have two options. Option one, buy the long call and sell short calls against it until it rises and you have a 50% or more gain. Then you can let your short call expire and then sell off the long call, or buy the short call back at a very small loss or small profit and sell the long call for a 50 to 100% profit. Your second option is to ride it to expiration, where it has no extrinsic value left or time value whatsoever, and you plan on exercising it. So let me show you guys an example on a firm. I have a long call option on a firm for January of 2025. And you can see that as the stock price goes up, so does the call option, just like stock. But the difference is with a 70 delta, if the stock price goes down $1, the shareholder or investor loses $100. $1 times 100 shares, $100. However, the long call leap option holder only loses $70 because the delta is 70. So you lose less money and there's less risk. The price you paid for the long call position is the max loss. So you can see here, let's say the stock price goes below my $30 call option. We can click on roll, and then we can go out an extra 3 months or keep the position the same because we're already out 10 months. We could just keep it in January and roll out to January again. We just want to drop the strike price. So if a firm goes to $29, I'll roll to $25. I'll click on $25. I'll click continue, and I'll try to get further down towards the bid price, maybe a little bit. Maybe I could get filled at $170. Basically pay $170 debit to go down in strike. So I'm paying $170 to save $500. And it only takes about 2 weeks of selling short calls against the leap to make that 170 back. That is how easy it is to protect your position in a leap option. Okay, guys, here is the $34 short position that I am in, the $34 call that I sold against my leap option. And I actually sold a $35 call, gained 50% as a firm went down like $1, and I rolled it to a lower strike to collect more credit, more juicy premium. So right now I'm up like $115 in 1 week, going from a 35 to a 34, which is really good because the price of the stock will recover. And because we have a leap option, which is like stock and long term, we can lose $100 in value on the stock by selling all these awesome contracts week in and week out. And then when the stock price recovers, so does the leap option. We've lost no money, but we've gained all that premium from the short calls that we sold. And as you guys can see right here, I just did this today and I'm already up $24, which is about 30%. Before the markets closed, I was up 10%. I took a $67 credit and now it's worth about $43. So you guys can see, as long as a firm stays below $34, it expires worthless and we keep all that juicy premium for ourselves. So if we want to roll, it's the exact same as if we own the shares. I'm going to roll out 1 week to next week and up to 35. Click on here and I will collect another $37 juicy premium. Or if we don't think it's going to make it there, we could click on $34.50 $50 and collect $55. But it's best to let this option decay throughout the week, even if it's going in the wrong direction or against us. It's best to let theta do its thing and decay the option up until expiration day on Friday. This way, you can roll your position for more of a credit. You see, guys, buying short-term call options less than a month out, like 1, 2, or 3 weeks, is kind of risky because sometimes a stock needs a month or 2 or even 3 or 4 months to recover. And if your option expires out of the money, then you lose all of the premium you paid for that option. Buying long-term leap options 8 to 10 months or a year or more out in the future gives you all the time needed for a stock to recover. You would not have the time for stock recovery in short-term options, 1 to 2 or 3 weeks. It could happen, but the risk is significantly higher. With leap options, the chances of losing money is a lot lower than it would be in short-term options. In fact, I've bought 6 leap options in the last month, and 2 of them I closed within the first week at a 30% profit. This truly is the proper way to buy call options. Buying options doesn't have to be short-term and risky. It can be long-term with low risk, high reward, and get you significant discounts into your favorite stocks. In an upcoming video, I'm going to show you guys how you can buy short-term put options in order to protect yourself against volatility during earnings season. Meaning when the earnings season comes around, like 1 to 2 week time period, I'm going to show you how to use short-term put options to protect your shares that you currently own. It is a great strategy and the proper way to buy short-term put options. But that's it for today's video. I'm hoping you guys learned something. If you enjoyed the video, be sure to give me a thumbs up and let me know in the comments below if you have any questions, as I take great pride in helping you guys out and answering everyone's questions. Thank you so much for being here. I greatly appreciate you, and hopefully you're learning and enjoying the videos. And remember, until the next video, let's grow our wealth together. Take care, guys.